A financial plan essentially is mapping your entire money life. So you need to figure out what you own and what you owe. You need a product set which allows you to target all of these, both in terms for investment, for maintenance and for withdrawal. So it's best to have a portion in gold through sovereign gold bonds or an ETF, but the rest of it, your investments have to be in mutual funds.
It's pretty much common wisdom that if you want to do something right, you have to plan for it first. So we plan our trips right down to the last detail of the itinerary. We plan out the menu before we have guests over. And in fact, to have a successful career, having a career path planned is also so important. But there's another kind of plan that's talked about all the time, a financial plan. It's supposed to help you buy that car and even all the way to, having your retirement sorted. But what exactly is it? Monika, what is a financial plan exactly?
As soon as you mention the words plan, people think that there's going to be a reduction in fun, right? Because you resist this whole putting discipline in the life, because somewhere discipline and fun don't go together. So one thing that I always say is that if you want to move from mindless fun to mindful fun, then possibly you are freed up to have a better quality of life if you just put some discipline in your life. A financial plan essentially is mapping your entire money life in terms of what you have today and where you want to go in the future. And then you find ways of making that happen. So you need to figure out what you own and what you owe. And when you do that, when you start putting together things that you own, whether it is bank deposits or insurance policies where some money is due, mutual funds, gold, stocks, your pension funds. When you start putting it all together, most people come back and say that, I have far more than what I thought I did. At your stage of life, there is going to be more loan than own. But that's fine, it goes away. When you do this audit of what you own, what you owe, things bubble up. For instance, you may find that you have a recurring deposit going with the bank, which is giving you, say, 7%. But you also carry credit card debt, which you're paying 24 to 36% as interest. Then a smart thing is to close that recurring deposit and pay off that credit card loan. So that's what the first step is really about today. Where am I today?
That's interesting because I always thought goal setting is for the future, but you're saying that it's about today as well, which does make sense because if I don't know where I stand right now, I can't really build a firm foundation for the future, right?
Correct. Absolutely. And a part of that is really to understand your own cash flows, how much comes in, what goes out. But the next stage is very interesting because that's where you actually involve the entire family. Kids, dogs, cats, whatever, husbands, whoever is there in the family, where you're putting down goals, specific goals for the future. Whether it is buying a house or a car, a vacation, a luxury good, and then the more sort of bigger, more serious goals like your retirement, children's education, marriage, or even just the fact of whether or not you will have a child. I mean, that's also a financial decision today. So this is where the entire family comes together to write out these goals, to say, this is our life today. Where are we going? What do we want out of life? And it's a good idea to put everything in.
From what I understand, goal planning has kind of changed over generations, right? It's very different for millennials in a lot of ways. I know that travel plans and lifestyle goals are definitely on the list, but there's also a lot of anxiety about, people are wondering about how global warming can just wipe us out suddenly and then we'll not even live to sort of realize those goals that we're planning for right now. How should we approach that?
It is a millennial question right now, isn't it? That we're just going to die, so why plan for the future? But I think the risk is of not dying.
True.
It sounds very horrible to say, but what if you're 60 and underprepared for retirement? Then what happens? So it's a good idea to actually plan for the future. And then if you don't die, it's a bonus because you know what, you'll have the money.
Okay, so we've put down the goals, we've sorted those out. What next?
Now is the really tough part where you start putting money values down. So suppose you've thought of a house, down payment, what does it cost today? You've thought of a car, what kind of a car do you want? You put that value down. Having a kid, education, marriage, retirement, you put the numbers down as much as it would cost today. Then you use something called inflation index. You want to see what it costs in the future. So if the goal is 5 years later, then you will index it for 5 years. Retirement is 30, 40 years later, you'll have to index it for that time. And then you have to work the numbers back to see what is it that you need to save today. Because there's inflation inflating the value of the goal, but if you're saving today, your investment is giving you a return which will help you target that large number. So you're fixing it and you're working your way back to see, for all of these goals, what am I saving today? And then that question will come into what am I saving?
Right, okay, that sounds like a lot of work and certainly a lot of math. I think that's enough to send people scampering.
Yeah. So one of the Nobel laureates, actually, econ person, he said that more than anything else, the toughest problem in finance is faced by a household because he has to target his retirement. And there are too many variables of inflation, of future incomes, of longevity, and all of that. So it's one of the toughest questions. An easier way right now is to just use some calculators, which are available online. If you do a Google search, you'll see the calculators. Use that to figure out all of the goals that you have, how much do you need for all of them.
I'm sure that's where the problem arises, right? The anxiety about not having enough money for all the goals.
Yeah, that's the time when you will remember why you involve the family, because now you will say, okay, there is this much money, but we need, so you have X, but you need 3X for your savings. So which goal are you going to start knocking off? Or the value of which goal will you start reducing? So it's interesting to do it with the calculator to say that if I reduce the value of the wedding from 60 lakh to 40 lakh, then the impact today is this much. Or if I give up on this luxury car and buy a simple hatchback, then my education fund will grow by that much. This cost benefit, this giving up of this today for that future, reducing the value of some goal to see how much it impacts your savings today. So it cleans up a lot of that expectations of what the family can provide in terms of, say, even luxury goods, vacations. If it's going to impact your future education, the child is not going to want, the next gadget, because then you see it so clearly. So it's really a good idea to do this together and figure out what are the important goals in your life.
Now, I kind of understand why you said when we discussed this in the first episode that mutual funds, being as diversified as they are such a competent way of investing for all of these goals. Because
that's right, because again, there are so many variables. You need a product set which allows you to target all of these, both in terms for investment, for maintenance, and for withdrawal. Right? Because there are three parts of this investment question. That one is you're putting in, second is maintenance, and when you redeem. So they're efficient in terms of understanding costs and the ability to be a product which morphs itself. The options are there that you can find a product for almost every need other than pure life insurance, medical insurance, and the roof over your head.
I think on that note, we'll take a viewer question. Okay. The viewer question is from Akshay, who wants to know what you think about gold as an investment. He's not too sure about investing in gold himself, and he asks if it would be wiser for him to use the amount that he's already set aside for buying gold to invest in some other product that can fetch him better returns.
So Akshay, always take a portfolio approach. We do still tend to think that we find one product and we hit all our money with it. But the whole diversification argument is really about putting your money in many baskets, not in one basket and watching it carefully, because almost we don't have control over how prices of gold will vary internationally, what the impact will be. 5 to 10% of your portfolio should be in gold. Remember, gold as an asset class does not throw off interest, rent, dividend. You only get profit out of it. It is a good hedge for inflation, but I would hesitate to put my entire portfolio into gold and then try and time the next growth asset. So fund managers, speculators are able to time. Average householders and people who are professionals are not able to time markets. So it's best to have a portion in gold through sovereign gold bonds or an ETF, but the rest of it, your investments have to be in mutual funds. So that's the short answer. Part in gold, but not the entire portfolio.
That's all the time we have, and we'll be back with the next episode soon. In the meanwhile, if you have any questions that you want Monika to answer, do write into us at moneywithmonika@livebin.com.
An investor education initiative by ICICI Prudential Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.